What's up, guys? Todd Robinson here, founder of Multifamily Dealmakers. I wanted to make this video for the newbie, for the beginner, for the one that has no idea what multifamily investing is and has a bunch of questions. Where do I even get started? What is multifamily investing? How is it different than single family homes? I want to answer some of those questions in this video, and I'm just going to talk off the top of the dome. And I just wanted to kind of talk to you about why multifamily investing will change your life. If you're looking to get out of the corporate world, you want to look out, you're looking to get out of the 9-to-5 rat race, and you want some financial freedom, you want some passive income. Multifamily investing at its core is investing in apartment buildings, not single family homes. So technically the definition of a multifamily property is a property that's more than, I believe, 4 units, a quadplex, if you would. So you have single family, that's just one house. You've got duplexes. Those are 2 houses joined together. Sometimes you have triplexes. I believe the legal definition is over 4 is considered multifamily. And those types of properties exist all around the country, and they serve a purpose in the market, in the supply and demand market of housing. And so investors who want to get into real estate and they want to build passive income, they want to build their generational wealth for them and their family, they often get invested in multifamily real estate. That's exactly what I did for myself, for my family. This past year, 2025, I purchased over $40 million of multifamily real estate myself with a team of investors, and it's provided me some financial freedom. And now I'm using that skill set and that experience as an investor and also as a real estate investment lawyer to guide other real estate investors and what I like to call emerging sponsors in the field of multifamily real estate. So why is multifamily better than single family? Think about it. If you own 20 houses, that's great. You got a big portfolio of 20 houses, but you've got 20 roofs to look after. You've got 20 different pieces of property, actual physical structures to maintain. You've got 20 tenants that you got to respond to at different times in different areas. It becomes 20 insurance policies. It becomes very hard to manage. So multifamily gives you what's called economies of scale. What does that mean? That means you buy one 20-unit apartment building, and guess what? You have all 20 tenants in one location. You've got one roof to deal with. You've got one insurance policy, and you've got one physical structure. Now, in real estate syndications, which we'll talk about in another video, is typically how multifamily properties are purchased, right? And the definition of a syndication, kind of jumping all over the place here, but this is important. It's a partnership. It's a partnership between a professional owner operator and investors. So the owner operator puts in the sweat equity. They're the ones that find the property, find the deal, get the financing, execute a business plan, and make money. The investors are the ones who put in the capital. So it's a perfect symbiotic relationship, and the operator's job is to make money and make profit for the investors. And if the operator does, the operator profits themselves. That's kind of the secret of how you can purchase real estate, especially multifamily real estate, with other people's money. That's why this whole OPM concept exists. But why is multifamily so much better than single family, and why it's just a great investment to begin with? Well, there's a couple of reasons. Number one, the tax benefits. Multifamily real estate is one of the best tax reduction plays you can possibly think of. Now, it doesn't reduce, it reduces your taxable income because you do what's called cost segregation. Cost segregation is a tax process where the actual building is, you extract the losses between the building and the real estate, and sorry, not the losses, but the value, and then you take a loss of that value. It's an IRS tax code thing, pretty complicated. But for high net worth individuals and high income earners, it provides a ton of relief from a tax perspective. So when you're out there raising capital for investors, to investors, you want to talk about the tax depreciation, because you can really only find that in multifamily. Number two, multifamily properties are evaluated like a business. This is an interesting aspect of multifamily investing in real estate. And for those that are getting involved for the first time, It's something you really need to understand. When you go out and you buy a single family home, you're really concerned about the appraisal value. You're really concerned about, what it appraises for and whether you can cover your debt service based on the cash flow. That's important in multifamily. But what's more important is what's called the net operating income. And what is net operating income? Net operating income is the number, it's like a net, you catch it. So you have your gross income, all the tenants pay you rent up here. You've got all your expenses. So your landscaper, your utility bills, the water bill, move out expenses, cleaning expenses, things like that for the unit. Then right here, you've got your net operating income, that number right there. That net operating income is the value driving factor for multifamily real estate. If that NOI increases, guess what? The value of your property increases. And that is the secret to multifamily investing. You want to buy it, you want to fix it up so you can increase that NOI, and you want to sell it. How do you increase NOI by fixing it up? I'll give you a great example. So we bought a bunch of properties this last year, and one of them in Milledgeville, Georgia, was what we call a value add deal. And how is it a value add deal? A value add deal means you're adding value to the property, to the bottom line, so that you can increase that NOI and you can get a bigger sale price. If we're renting, in this example, we're renting this property at $1,200 per month for a 2-bedroom, I believe. But it's kind of a dated unit, okay? The kitchens are a little dated. There's no backsplash. The countertops are Formica countertops. The lighting is old and depressed. It's just kind of needs to be freshened up. Well, you've got to spend some money to freshen it up. That's where you add value. So you come in as the owner and you redo the kitchen. So for those that have kind of a design flair, it's a really interesting project, a really interesting thing to be into. And so you come in and you add value. You replace the kitchen countertops. You put in a backsplash, perhaps. You put in canned lighting, freshen up a coat of paint, maybe get new appliances. It's going to cost you $5,000, $6,000 to do this. But if you were charging $1,200 a month and you update this kitchen, now you can go out and market it for, let's say, $1,500 a month. That's your value. You've got 20 units, 50 units like this. You now, doing the math, well, let's say it's $1,000 a month for 50 units. That's $50,000 a month for your top line revenue. Well, let's say you're now able to charge $1,500 a month. What's that? $75,000 roughly, if my math is correct, per month. Your top line revenue increases. Your expenses will generally stay the same. You guess what number is larger than that at the bottom? Your NOI. Your net operating income is greater. So you increase your NOI, you then go and sell the property for a larger number, because values of multifamily real estate are really driven by the NOI multiplied by what's called a cap rate, capitalization rate. Capitalization rate is essentially, it's the financial metric that looks at the capitalization, basically how much money are you getting back, or what's the percentage interest rate you're getting back of the money you invested. And it's kind of a market-based market-based financial metric, and increases and decreases based on the market and based on the type of property. It's pretty risky properties will have a higher cap rate. Pretty stable core plus properties, meaning like city center properties, high density properties, are going to be lower cap rate. Property we just bought in Buckhead for $10,660,000, best part of Atlanta, Georgia. It was at a 5 cap. 5 cap's really low. The one we bought in Georgia for $5.5 million, that was at a 7.5, 8 cap, I believe, because it's kind of an outer area. So these are, again, financial metrics that you're going to learn as a new multifamily investor. I could go on and on about what else you need to do, but let me just give you the basics in the last couple of minutes here. You need to determine what market you're going to invest in. Okay. If it's the Southeast. Southeast is the best. That's where I'm located, Atlanta, Georgia. But pick a market, pick a state, pick a city. I've got a good buddy of mine who's investing just in the Carolinas. He's becoming an expert in Carolina multifamily real estate, north and south. That's brilliant. Georgia, I obviously advocate for. Alabama, Tennessee, some of these southeastern states, some parts of Texas, Austin, Texas, I'd stay away from. But pick pick a focus. If you're going to be all things to all people, what do they call you? Jack of all trades, master of none. Pick a market, stick with it. And then I want you to start with smaller properties, 10 to 30 units, perhaps, maybe up to 50 units, because you get those economies of scale. And believe it or not, it's easier to purchase a large 50 unit property than it is to purchase a single family home, for sure, or even a 2 or 3 unit property or a 10 unit property, right? Because you have that economies of scale. After you're doing that, you need to learn how to underwrite. And this is, again, something I teach in Multifamily Dealmakers. But again, looking at multifamily as a business, part of that business is actually underwriting the property. And I've got, if you're interested in joining the community, even the free version, you can get access to some of that stuff. But you literally go through a financial model, and the model will tell you if the property is worth buying or not. It'll tell you what your returns are to your investors, what's your cap rate, what purchase price you need to be at in order to buy it, and what your sale price is, right? So mastering underwriting is the next important skill set once you're deciding to go through this journey. I've got lots more to say, but I want to just do this quick video on why multifamily is so much better than single family homes, and some of the initial things as a beginner that you're going to be exposed to either in my group or whatever group you want to join. But as you go down this journey, I wish you the best of luck, all the success in the world. If you have any questions, please reach out. Let's go.